Walk into any major city, drive down any prominent suburban artery, or navigate the busiest intersections in the world, and the golden arches are there. Millions of customers exchange cash for calories every single day, believing they are participating in a vast global food network. But the burgers, fries, and shakes are essentially a distraction. The true economic engine operating beneath those fryers has very little to do with fast food. McDonald's is not fundamentally a restaurant chain. It is one of the most formidable, single-tenant real estate empires on the planet. Unveiling this reality requires looking past the menu boards and directly into the balance sheet. The corporation owns the land and buildings for thousands of its locations, leasing them back to the people who actually flip the burgers. This invisible architecture of ownership transforms a low-margin, highly volatile food service operation into a predictable, high-yield wealth generation machine. The independent operators take the daily, grueling risks of staffing shortages, food spoilage, and customer service complaints. The corporation simply collects rent, sitting securely on prime commercial land that appreciates in value year after relentless year. This structure was not the original plan. When Ray Kroc first encountered Richard and Maurice McDonald in 1954, he saw a highly efficient hamburger stand in San Bernardino, California. Kroc, a struggling milkshake machine salesman, convinced the brothers to let him franchise their revolutionary assembly line concept nationwide. His initial business model was straightforward but fatally flawed. He took a meager 1.9% commission on the gross sales of his franchisees, and he was contractually obligated to hand half of that tiny fraction back to the McDonald brothers. The math quickly proved unsustainable. Kroc was expanding the brand at a breakneck pace across the American Midwest, but the revenue generated from tiny fractions of 15-cent hamburgers barely covered his corporate operating costs. He was building a national phenomenon while simultaneously hovering on the edge of personal bankruptcy. The rapid growth of the franchise model demanded immense capital that a simple royalty stream could never provide. The entire enterprise was a financial house of cards, threatening to collapse under the crushing weight of its own explosive popularity. The turning point arrived in 1956 through a financial consultant named Harry Sonneborn. Sonneborn reviewed Kroc's bleeding ledger and diagnosed the structural defect immediately. He famously informed Kroc that the company was not in the food business at all, but rather the real estate business. The only reason to sell hamburgers, Sonneborn argued, was to provide independent tenants with enough reliable cash flow to pay their rent. This single, counterintuitive insight fundamentally altered the trajectory of corporate wealth in the 20th century. Sonneborn engineered a new corporate entity, eventually known as the Franchise Realty Corporation. Instead of merely selling a license to use the McDonald's name and recipes, the corporation would acquire the physical land and construct the building for a new restaurant location. They would then lease that specific property to the franchisee. The genius of this arrangement lay in the strict lease terms. Franchisees were required to pay a fixed base rent or a set percentage of their monthly gross sales, whichever number happened to be higher. This mechanism created a perfect, self-adjusting economic hedge. If the broader economy stumbled and burger sales dipped, McDonald's still collected its guaranteed minimum rent, ensuring corporate cash flow remained uninterrupted. If inflation drove menu prices up or a specific location became wildly successful, the percentage of sales clause automatically captured that financial upside. The corporation entirely insulated itself from the operational hazards of the restaurant industry, while perfectly positioning itself to absorb the maximum profits generated by its hardest-working local operators. The financial leverage generated by this closed-loop system was staggering. McDonald's could approach commercial banks for mortgages to buy new parcels of land, using the guaranteed lease agreements from their eager franchisees as rock-solid collateral. The franchisees effectively paid off the corporate mortgages through their monthly rent checks. Once the debt was cleared, McDonald's owned prime commercial real estate free and clear, funded entirely by the labor and retail sales of its independent operators. This cycle of borrowing, buying, and leasing became an unstoppable flywheel of capital accumulation. For the individual franchisee, the arrangement presented a complex, high-stakes dilemma. They gained immediate access to a globally recognized brand, a proven operational system, and massive national marketing support. However, they surrendered ultimate control over their physical business environment. They could not shop around for cheaper real estate or negotiate standard commercial leases with independent landlords. They were locked into a rigid landlord-tenant relationship where the landlord also dictated exactly how they ran their business, what kitchen equipment they used, and what specific prices they charged the public. This dual layer of control gave McDonald's unprecedented authoritarian power over its vast network. If a franchisee failed to maintain stringent quality standards, the corporation did not just revoke a paper licensing agreement, it legally evicted a tenant from the premises. The real estate model enforced absolute, unwavering compliance. It also meant that the corporation's internal incentives were heavily weighted toward aggressive geographical expansion. Identifying and securing the best intersections, the most visible highway off-ramps, and the highest traffic urban corners became the true core competency of the executive team. As the decades passed, this localized American strategy scaled into a massive campaign of global expansion. The company systematically replicated its real estate blueprint across Europe, Asia, and Latin America. Whether securing a historic, centuries-old building in central Paris or a bustling, neon-lit corner in downtown Tokyo, the underlying financial mechanism remained identical. The physical dirt beneath the restaurants often held more long-term, intrinsic value than the millions of meals served above it. By securing prime locations internationally, McDonald's permanently embedded itself into the urban fabric of the global economy. The sheer scale of these physical holdings eventually rivaled the portfolios of the world's largest sovereign wealth funds and elite institutional property managers. Today, the corporation owns the land or the building for roughly 80% of its nearly 40,000 locations worldwide. This represents tens of billions of dollars in hard, appreciating assets sitting firmly on the corporate balance sheet. While rival fast food competitors engaged in frantic, margin-crushing price wars over value menus, McDonald's calmly collected rent on some of the most coveted commercial real estate on earth. The profound structural resilience of this model was severely tested during the 2008 financial crisis. As global credit markets completely froze and consumer discretionary spending plummeted, traditional retail chains and restaurant groups faced immediate existential threats. Yet, the Golden Arches stood remarkably firm amidst the economic carnage. The corporation's massive, unencumbered real estate holdings provided a bedrock of tangible value that insulated it from the worst of the market volatility. While other brands scrambled to renegotiate leases or shuttered unprofitable locations, McDonald's relied on its predictable rental income streams to easily weather the storm. The echoes of that severe economic downturn eventually sparked a new, high-stakes battle over the company's fundamental structure. In the years following the crisis, aggressive activist investors looked at the corporate balance sheet and saw a massive financial inefficiency. They argued that McDonald's was essentially a massive real estate investment trust, or REIT, trapped inside the shell of a fast food company. These investors launched public campaigns demanding the corporation spin off its property holdings into a separate entity, theoretically unlocking billions in immediate shareholder value through highly favorable tax structures. The corporate leadership in Chicago vehemently and successfully rejected this immense Wall Street pressure. Spinning off the real estate would have permanently dismantled the very engine that had driven their market dominance since the late 1950s. Losing ownership of the land meant losing the ultimate, uncompromising leverage over the franchisees and exposing the core business to the unpredictable, cyclical fluctuations of the commercial property market. The board understood that the intrinsic value of the company was not just in the land itself, but in the unbreakable, symbiotic relationship between the rent collected and the burgers sold. By retaining absolute control of the dirt, McDonald's preserved its unique ability to dictate terms during periods of severe economic inflation. When consumer prices inevitably rise, fast food menus naturally adjust upward to compensate for higher ingredient costs. Because the corporation collects a percentage of those gross sales as rent, its real estate yields automatically and frictionlessly adjust for inflation. This creates a deeply entrenched, almost unparalleled pricing power. The physical land acts as a financial sponge, soaking up excess capital generated by the franchisee's labor and the consumer's ongoing willingness to pay higher prices for a quick meal. This unseen dynamic fundamentally shifts how one must view the simple transaction at the drive-through window. The customer handing over a credit card is not just buying a hot meal. They are actively providing the microtransactional liquidity that fuels a global property empire. A significant portion of every single dollar spent flows rapidly upward, bypassing the local operator's thin profit margin to service the debt or pad the equity of the distant corporate landlord. The fast food chain is merely the highly optimized mechanism designed to extract maximum rent from prime commercial geography. The broader implications of this strategy extend far beyond the narrow confines of the restaurant industry. It serves as a definitive masterclass case study in how modern corporate wealth is truly accumulated and protected. Profit margins on physical consumer goods are notoriously fragile, highly susceptible to global supply chain disruptions, rapidly changing consumer tastes, and relentless cutthroat competition. But prime commercial real estate, coupled with an ironclad, long-term lease agreement, offers an impenetrable fortress of financial stability. The most successful corporations often discover that their primary consumer product is merely a Trojan horse used to acquire and control scarce, appreciating assets. Ray Kroc's ultimate legacy is not the popularization of the assembly line hamburger or the invention of the modern drive-thru. His lasting, monumental contribution to global business was recognizing that controlling the ground beneath the economic transaction was infinitely more lucrative than the transaction itself. The franchise model he painstakingly built, guided by Harry Sonneborn's brilliant real estate revelation, created an impenetrable economic moat. It brilliantly transformed localized operational risk into centralized, mathematically guaranteed returns, building a sprawling financial fortress cleverly disguised as a friendly neighborhood family restaurant. The Golden Arches, therefore, stand as something much more significant than a convenient beacon for hungry travelers on a dark highway. They are the visible markers of a vast, meticulously managed, and ruthlessly efficient property portfolio. Unveiling this truth completely redefines the nature of the company's unprecedented historical success. It is a striking testament to the enduring power of hard asset ownership over mere operational efficiency. Long after the digital menus change and consumer dietary habits inevitably evolve, the land remains, silently and continuously generating wealth, proving that the foundation of this empire was quite literally built from the ground up.